Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies here, to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamwin here. This is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve, let's kick things off with some intriguing numbers coming out of Toronto. The Toronto Regional Real Estate Board has reported that home sales in September rose by 8.5% compared to last year. That's quite a jump, wouldn't you say?
Yes, Andy, it's definitely a significant increase. But it's important to note that while sales have gone up, prices have actually been declining. It's a complex dynamic and reflects the shifting market conditions.
Absolutely, Steve. It seems like buyers might be taking advantage of these lower prices. But of course, it's a double-edged sword. Sellers might not be seeing the returns they were hoping for.
Right, Sandy. The 5,592 homes sold in September represent not only an 8.5% increase from the same month last year, but also a 2% increase on a seasonally adjusted basis from August. It shows that the market is still quite active despite the price drops.
It's a fascinating time, Steve. For buyers, it's an opportunity to get into the market at a potentially lower price point. But for sellers, especially those who bought when prices were higher, it might be a challenging time.
True, Sandy. It's all about timing and strategy. Sellers need to be savvy and perhaps more patient in this environment, while buyers might find this an ideal time to make a move if they can secure the right financing.
And speaking of financing, Steve, with the market shifting, I imagine many potential buyers are looking more closely at their mortgage options to ensure they're making the best decision possible.
Absolutely, Sandy. With prices declining, it is even more critical for buyers to understand their financial situation and explore different mortgage products to find one that best suits their needs. This could be an opportunity for them to negotiate better terms with lenders.
Steve, let's talk about something that's always on the minds of potential homebuyers: finding the best mortgage lender. Forbes Advisor Canada recently published its list of the best mortgage lenders in Canada for 2025. It's an essential read for anyone looking to make informed decisions about their mortgage options.
Absolutely, Sandy. This list is a great resource. Forbes evaluated over 70 lenders across the country, looking at interest rates, loan options, access, and customer service. This comprehensive approach helps potential buyers make well-rounded decisions.
Right, and it's not just about the interest rates, although those are crucial. The lender's reputation and customer service can make a big difference in the overall experience. Alterna Bank topped the list this year with its competitive rates and a full suite of complimentary banking services.
Alterna Bank is a solid choice, especially for buyers under $1 million who are seeking low rates. However, it's important to note that they have a maximum property value cap of $1 million and a 25-year amortization period, which might not suit everyone, especially in high-priced markets.
That's true, Steve. For those who need more flexibility, CMLS Financial is another great option. They've been around for 50 years and offer some of the best 3-year and 5-year rates. They might not have the flashiest website, but their rates are definitely worth considering.
CMLS Financial is intriguing, especially for no-frills buyers who want low rates. They offer a comprehensive selection of fixed-rate mortgage terms, but keep in mind there's no 6-month term or open mortgage option, and you need a fair credit score to qualify.
And for those in Quebec, Laurentian Bank of Canada might be the best fit. They offer a wide range of mortgage term options, including some less common ones like 18 months and 4 years, which can be tailored to specific needs, particularly if you're buying in Quebec.
Laurentian Bank is indeed a good choice for home buyers in Quebec, with its competitive rates on popular terms. However, they don't have any branch locations outside Quebec, and there's no online mortgage application option, which could be a drawback for some.
Another interesting option is B2B Bank, which caters to borrowers with bruised credit or alternative income sources. Their look-back rate guarantee is a unique feature that ensures you get the lowest rate at the time of closing.
B2B Bank does offer a broad range of mortgage terms and is particularly appealing for traditional and non-traditional borrowers. However, they don't accept mortgage switches and transfers from all lenders, and there's no online application, which could limit accessibility for some clients.
For newcomers to Canada, the Canadian Imperial Bank of Commerce offers special programs, which can be a significant advantage. They also have an extensive branch network, providing ample opportunity for in-person assistance.
CIBC's transparent rates and special offers for newcomers make them a strong contender, although potential borrowers should be aware that they need a good credit score unless they qualify under the newcomer criteria. They also lack online application options, which might not suit everyone.
It's important for buyers to evaluate what each lender offers and find what aligns with their needs, whether it is low rates, flexible terms, or tailored programs for specific situations.
Exactly, Sandy. Each lender has its own strengths and potential drawbacks, so it's crucial for buyers to do their homework and consult with mortgage professionals to find the best fit for their financial circumstances.
Now, Steve, let's shift gears and talk about Atrium Mortgage Investment Corporation. They've just declared a cash dividend of 7.75 cents per common share for September 2025. This isn't just any dividend announcement. It's part of Atrium's broader strategy to enhance shareholder value, notably through their Dividend Reinvestment Plan, or DRIP.
That's right, Sandy. Atrium's DRIP is quite appealing for investors looking to compound their returns. It allows shareholders to reinvest their dividends automatically into additional shares at a 2% discount to the market price and without any additional transaction costs. This can be a smart move for those focused on long-term growth.
Absolutely, Steve. For many income-focused investors, this dividend, set to be paid on October 10th, 2025, underscores Atrium's commitment to providing a stable income stream. It's a reassurance in today's dynamic market environment.
And from Atrium's perspective, the DRIP helps retain capital within the company. While cash is still distributed to those who opt out, reinvestment by participants provides an ongoing source of equity financing. This supports Atrium's lending activities and growth initiatives, which is crucial for their business model.
That's a great point, Steve. The ability to reinvest dividends at a discount and without fees not only simplifies the process for shareholders, but also promotes efficient capital allocation. Over time, this can lead to a more substantial investment, generating greater future dividend income and potentially enhancing total returns.
It's a win-win situation, Sandy. Atrium's consistent dividend policy and attractive DRIP make it an appealing choice for income-focused investors and those seeking capital growth through compounding. It also helps stabilize the company's stock price by creating consistent demand for its shares, which can mitigate market volatility.
And on a larger scale, Atrium's approach sets a benchmark within the mortgage investment corporation sector. Other companies might feel the pressure to offer similar shareholder-friendly programs, potentially leading to a broader enhancement of investor returns across the industry.
Indeed, Sandy. In a market where reliable income streams are in high demand, Atrium's strategy positions them well among their peers. Their DRIP encourages long-term investment and shareholder loyalty, fostering a stable investor base and reducing the impact of short-term market fluctuations.
Looking ahead, Atrium's focus on prudent mortgage underwriting and portfolio management will be key to sustaining their dividend payouts. The success of their strategy will depend on navigating the evolving Canadian real estate market and interest rate fluctuations.
That's true, Sandy. Investors should keep an eye on Atrium's quarterly earnings for insights into their financial health and any adjustments to their dividend policy. Their consistent return of capital, coupled with the DRIP, suggests a positive outlook for shareholders who choose to reinvest.
All in all, Atrium Mortgage Investment Corporation's recent dividend declaration and robust DRIP highlight their commitment to shareholder value. It's a strategy that not only benefits individual investors, but also contributes to the company's financial resilience.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.